Hello, my name is Julien Nillon. I'm a financial analyst and the founder of LPE Research, an independent equity research firm exclusively dedicated to asset managers and specialized on French small caps. Last week, we have been working on the company Quadient, and today I am going to present our first analysis on these stocks. Before I begin, I would like to remind you that this video is not an investment advice, but only an opinion. We do not do any business with Quadient and do not hold any long or short positions in its shares. Having said that, let's get started. Quadient, formerly known as Neopos, is a company that originally specialized in the manufacture of postage meters. The group, which is now the world number 2 in mail-related solutions, suffered from a structurally declining market but remain profitable and generate a good level of cash flow. However, in response to the decline of its main market, Quadient has diversified into two other activities. Its first other division, Intelligent Communication Automations, offers management software for communications, contract, payslips, account payables, and receivables. Its second other division, Parcel Locker Solutions, install and manage a large number of automatic lockers. It should be noted that the group realized more than half of its sales in North America and 40% in Europe. Let's now review the past performance of the group. For years as an industry leader, Quadient has enjoyed high profits. Unfortunately, when physical mail began to decline, so did its main market, and the company started to see its margins deteriorate. To face this and to find growth relays, the group decided then to multiply acquisitions. Unfortunately, this strategy proved to be a failure. While the group maintained its sales for a while, it was unable to manage a multitude of diversified companies and to control its costs. At the end, margin deteriorated further. In 2019, a new management team arrived and began a major refocusing, disposal, and restructuring program. Unfortunately, results fell again as a result of the COVID crisis. However, the new management remained confident that it can return the group to growth. Let's then review the prospect of each division to understand why. First, in the mail-related solution division, management objective is to limit the decline in sales while maintaining a good margin levels and generate strong cash flow. To achieve this, Quadient can rely on its market position, it is number 2 worldwide and number 1 in Europe, but also on the fact that it has excellent visibility on its revenues. 75% of the turnover is generated by rental and leasing contract with a duration of 5 years. The group is also continuing on its refocusing and a new emphasis on its costs. Above all, unlike its US competitor Pitney Bowes, Quadient has decided to continue to invest in new machines, and thanks to that, gain market share. At the end, despite risk, we believe the sales decline in this division will be lower than the 5% expecting fall of the market. Let's now review the Intelligent Communication Automation division, which represents nearly 200 million euros in revenues. This division is enjoying leading position in its specialties and strong growth momentum due to digitalizations. However, the management has undertaken to accelerate its growth by making major investment and set ambitious targets. We believe those targets are achievable. First, the group is in the process of integrating its various solutions into its cloud platform and moving from a license purchase model to a SaaS model. Second, Quadient has strengthened its receivable and payable management offering by acquiring 2 small but successful companies, YayPay and Beanworks. Finally, the group intends to use the very large customer base of its mail-related solutions division to expand. Let's review now the last division, the Parcel Locker division, which is recent and still small, but is a particularly promising activity. Indeed, In a few years, Quadient has become the second largest global player in this business behind Amazon. The company has 15,000 lockers installed and expects to double this number within the next 3 years. Indeed, this market linked to the development of e-commerce is booming. The numbers of lockers could be multiplied by tens in the next 5 years in certain areas. This activity requires significant investment, requires a real know-how, but generates excellent levels of recurring profit thanks to subscription systems. To double this size in this business, Quadient plans to invest 40 million euros each year. Now the bad news. When you do the math and add the prospect of the different divisions, the group overall profit outlook remains disappointing. The increase in this year's post-COVID result is expected to be moderate. For the next 3 years, the group management anticipates organic top-line growth of only 3% per year and operating profit growth barely above 5%. This is unfortunately not a surprise. While Quadient is highlighting its two very dynamic divisions, they still account for barely 50% of group profits. The mail-related solution division, whose profit will continue to decline, will account for the bulk of profit for a long time to come. If for our part we expect good growth in EPS, it's only because lower restructuring charges. As a consequence, in the first approach, Quadient appears very fairly valued. To value the company, we must first consider its history of constant decline in results in recent years. We must also take into account the company's stock reputation, which is much better than what might think, thanks in particular to the good focus of the management on value creation and the very good communication. It is obviously necessary to take into account the low growth profile of the group. Finally, we should look at the valuation of the main competitors, Pitney and Francotype, which trade on a 2022 EBITDA multiple of 3. Quadient is trading at close to 5 times its 2022 EBITDA. At first glance, a premium appears justified, but this does not authorize any real revaluation either. But there is a hidden value. Discovering the true value of the company requires not stopping at the general profile of the group, but going into details. Indeed, if the mail-related solution division represents more than 80% of the group profit, it hardly represents 20% of its value. If we consider its high level of profitability and the multiples of its competitors, the mail-related solution division must be able to be valued 0.5 times its turnover, that is 375 million euros. The Parcel Locker division, on the basis of twice its turnover at 10 times its future operating profit, can be valued at 400 million euros. Above all, on the basis of the competitors, the software division of the group should be valued 10 times its sales, or 2 billion euros. After that gives you a value of 2.2 billion, a valuation 3 times higher than today. Should we expect Quadient to triple in value and rise to 65 euro? No, unless the company decides to list its software division. I hope you have enjoyed this video. If you would like to know more about our opinion, you can contact us and order our first analysis pack that includes our presentation, our forecast, and valuation model, our stock reputation measurement, and allow you to discuss with me. In the meantime, do not hesitate to subscribe to our YouTube channel or to visit our website at lpresearch.com. Thank you very much and see you soon!